April 2nd is US Liberation Day, according to President Trump, but most market participants, you and I, know it as Reciprocal Tariffs Day. There has been a lot of uncertainty around tariffs and market remain on tenterhook. To dive deeper into the tariffs issue, let's connect with some important market voices. I'm joined by Neelkanth Mishra, Chief Economist at Axis Bank and Head of Global Markets Research at Axis Capital. Thanks very much, Neelkanth, for joining us. Simple question, but not so simple answer. As we go into the 2nd of April, they've said that they will hand over all countries a number, a reciprocal tariff number. In your opinion, what will that number be for India?
It is wise to even surmise that. As we think about the economy and the markets, I think it's very important to see this as one of many important milestones, because this will just be a starting point. It is very important to understand what is it that the Trump administration is trying to achieve. As we see it, underneath the somewhat chaotic announcements of tariffs today and no tariffs tomorrow and then tariffs the third day, there are three broad objectives that the U.S. is trying to achieve, the current administration. The first is that they are no longer willing to bear the costs of multilateralism. So we are moving from multilateralism to bilateralism. That will have its own repercussions, and we can discuss that. The second is that they realize that being the reserve currency of the world has meant that they've had to sustain a current account deficit. The currency is overvalued, and they want to do something about it. I don't think they're 100% clear on exactly what needs to be done, but they want to address the problem. And the third is that most people in the current administration want to go back to the glory days of pre-World War II isolationist America, where they focused on their own strengths and they benefited from it. And over the next year or two, you will see them moving and pushing in that direction. And I think we have to anticipate that. So what that number is on April 2, frankly, will matter a lot less. But I think these changes are what we have to get used to.
Many in the market are of the view that this is a hump to get over, and then from there things will get easier. You were suggesting otherwise. Have I read that rightly?
Yes, absolutely. See, remember that we are reshaping the world order. The post-Second World War world order is now being reshaped. And remember that tariffs are only one form of industrial policy. You have many other forms of industrial policy which are not possible today because people are worried about the World Trade Organization. Now, suppose export subsidies. Export subsidies are not allowed. So companies and countries don't. Most countries don't have them, at least not explicitly. Now, imagine that you are only having bilateral relationships now. And if one country starts to subsidize their exports of a certain product, so long as it doesn't affect the US, they're not going to be bothered about it. And the countries will start working on these themes. They will start raising the barriers. So we are going to see a lot of chaos, a lot of uncertainty. And imagine being a country planning your supply chains in this process. It is going to be very difficult.
Absolutely. What does the math say right now, the models that you've already sort of arrived at? For India, that blended tariff rate or the weighted average tariff rate, to what extent could it go up by? That's part A of my question. And part B is that since we're still not a fully export-oriented economy, what is the implication on GDP growth? How many basis points?
This is why, while I'm sure you and your viewers would like certainty on a particular number. So suppose we say that if there were true reciprocal tariffs, the impact would be about $4 to $5 billion, or if say it was $8 billion. So it's like 0.1 to 0.2% of GDP. But is that the right number? Is that the real impact on GDP? Because over a period of time, of course, there will be negotiations. Not all of it will be borne by the supplier. Some of it will be borne by, and it'll vary from. So suppose you are a pharma company, and there is a very concentrated pool of buyers, but the cost of production in the US is 80% higher. So there's no way that they can really replace you with someone else. In which case, you actually have some bargaining power. If you are an auto component maker, and what price increases can happen. So these things will settle over a period of time. You also have other alternatives. You can actually reroute it through some other channel. And therefore, the impact could be actually far lower than that. So in fact, for India, given that exports to the US are, less than 2% of GDP, whatever be the impact, so if 2.5 goes to 10, it's 7.5% of 2%. Frankly, that's not what I would worry about the most. I know it will affect a certain set of companies a lot. What I'm much more worried about is how uncertain this makes things for the world, and therefore what happens to global markets and what happens to the global economy. And therefore, the channel through which I think this uncertainty will affect us will be the financial markets and not as much the trade. To give you perspective, if, say, corporate capex as a percentage of GDP globally is, say, 8 to 10%, it's higher in India, it's higher in China, but globally it should be about 8 to 10%. And if 10% of those companies, 10-12% of those companies or of those investments get postponed by 6 to 12 months because of the uncertainties that we're talking about. We're talking about a 1% of GDP growth globally getting shaved off. It will show up over 12 months, but that's a substantial reduction. And imagine the second, third order effects of that. And then what that does to equity risk premiums, the uncertainty.
So just to understand this again, what you're saying is that expecting a 1% GDP impact, global, world GDP, that probably is a realistic number that we can work with. And therefore, there could be significant impact on financial markets, including ours, right?
That's the order of magnitude. See, I know we are all grappling with a lot of uncertainty, but remember that these are the first salvos being fired. Everyone is wanting to have a negotiation. Soon enough, as the implications start getting clearer. So, for argument's sake, suppose the Venezuela-related tariffs also take effect, and now there is 45% impact on Chinese exports to the US. What will happen to Chinese exports to Indonesia, to Malaysia, to India? And then how will our economies respond to this? Will we respond to this with currency, with non-tariff barriers? Will we then start raising tariffs, in particular on Chinese imports or imports from China? Remember that this is just the first salvo being fired in what is actually going to be a multi-year trade war. It is unwise to anchor yourself, this is how it will happen, and then, finally, then we are sorted out. Which is why I think we have to gear ourselves up for sustained period of uncertainty. And that is why I started off with the strategic objectives that I think the Trump administration is driving towards. Imagine that, even the auto component example. I was reading this article that now the US is saying that if the auto components in the imports from Mexico are US manufactured, there's nothing. It's almost like the popcorn on GST situation here, right? How are you? Imagine the complexity of the trade flows. It is, I think at this stage, it is reasonable to expect there will be a lot of uncertainty and not try to quantify everything immediately.
You said the main channel through which this is going to affect us is going to be markets, financial markets. You mean financial markets are in for a bit of a turmoil?
Yes.
Which means lower equity markets overall, broadly. There'll be tough for markets to do well.
Yeah, higher equity risk premium, and which means lower price to earnings multiple.
Okay. Is there a risk of overcompensating for all this? That we are maybe, because this is a 4-year it's a 4-year presidency. So, as you said, post-World War consensus is being broken now. I mean, what if Democrats come back? So will we kind of completely revert now, or this is a permanent break? Or not? Tough to know.
No. It's like, you start a war when someone slaps the next person, and then they slap them back, and then the next person punches. And then you say, oh, now, or everyone behave. It's very
happen.
hard to... Well, one hopes that it will happen, because I think the previous world order, I think everyone behaving with certain common norms is actually not a bad thing. And eventually, even after the Smoot-Hawley and the breaking of the gold standard and all of that, finally some agreement came through in Bretton Woods, right? So it takes, I'm not saying it will take 10 years, but 4 years is a long time. Second, once you break things apart, even if you reset them, there will be new optimizations. And clearly there were some things that were wrong or that were not working in the previous order, which is why we are seeing this. So
this is happening.
It will be a different reset, but that's quite some time away. We all should be optimistic about the world.
Thank you very much, Neelkanth, for joining us with those insights. This calls for a much deeper chat, but we will connect with you post the 2nd of April, opening salvo, as you called it. Let's slip into a short commercial break. On the other side, we continue to dive deep into the tariff issue. We will connect with Sunil Kaul of Goldman Sachs in just a bit.